Welcome back, everybody. Today we're talking about earnings, and more earnings. With companies reporting just about every day now, let's go ahead and take a look at how 4 of my portfolio companies did for the previous quarter. And those companies are American Express, Visa, Google, and MSCI. So let's go ahead and get started. Let's start with American Express. Now, Amex is my biggest overall gainer in my portfolio at close to 60% gain in a little over a year that I've held it. And if you remember, here's what I said I was looking to see for this quarter. Now, for Amex, I want to see total revenue up and portfolio quality in terms of delinquencies and write-offs still strong compared to their peers. They've been strong in this area for a while and on a great run overall as a stock. I just want to see that continued overall growth and health of their portfolio, and hopefully no signs of a weakening core customer. So let's go over how Amex did for the quarter. Amex beat on earnings and missed revenues by about 1.5% off of analyst estimates. And the market reaction sent Amex's shares down about 5% on that day. So let's take a deeper look at what they actually reported. Amex had total revenues of $16.3 billion, up 8% year over year, and they had earnings per share growth of 44%, but that includes benefits of a one-time sale, which we're going to talk about more in a minute. Adjusted earnings per share growth, though, was still a very good 21%. And if we take a look at their revenue breakdown, we see that card fees and net interest income are driving a lot of their growth. And what's interesting about this is, remember, Amex is not just a card network, they're also an issuing bank, which is how they're really different from Visa and MasterCard. Because Visa and MasterCard process transactions, but they don't actually issue cards, which means that they don't take the credit risk that banks take, but it also means that they don't get as much of the interchange revenue or any card fee revenue or interest revenue. And it just so happens that for Amex, net card fees and net interest income are the 2 highest growth revenue segments for this past quarter. So it's just an interesting nuance that we can use to compare these 3 card networks against each other. So, okay, Amex has higher card fees, they have higher interest income, which means that people have higher revolving balances that they have to pay interest on, and they're paying more in fees. So the question we have to answer is that actually sustainable? So first, let's take a look at their card metrics. Their total billed business and network volumes hit an all-time high in the quarter. So what that tells me is they're not seeing a decline in usage or spend, even with the higher fees and revolving balances. And that all-time high is actually across all the different slices. So U.S. consumer, commercial, and international card services. And their worldwide total loans and receivables, which is basically the credit they've extended to their customers with their credit products, as you can see, has been growing as well. And then lastly, if we take a look at the credit metrics on their portfolio, we see that delinquencies actually dropped to 1.2%, which is pretty consistent to what it's been and still below pre-pandemic levels, while charge-off rates stayed at 2.1%, again, still under pre-pandemic levels. So overall, what you see is that Amex is growing their revenue and is primarily being driven by card fees and interest income. But their customers still seem to be pretty healthy, with their delinquencies and charge-off rates staying pretty steady and still below pre-pandemic levels. So overall, it's a really good story for Amex. And then if we just take a look at what else they announced, they're actually raising their full-year earnings per share guidance, which was originally 13 to 17%, to now be 19 to 23%. And that's because the full gain from the Assertify sale is being put directly to the bottom line. And Amex said specifically, based on the strong performance of our core business, we believe we can increase our marketing investments by around 15% over last year without using any of the transaction gain, while still delivering exceptional earnings results this year. As a result, we've made the decision to drop the entire gain to the bottom line and are raising our full-year earnings per share guidance. So overall, I thought Amex had a really good quarter. It was a nice balance of continued growth, but then continued strength in terms of credit quality and their core customers. So why the market decided to drop at 5%, I have no idea. But to me, it looked pretty good. Okay, next up is Visa, and if you remember, here's what I said I was looking to see. For Visa, I simply want to see, is their double-digit growth and high profitability story still intact? Do we see any weakness with the economy? Do we see their growth story slowing at all? So let's take a look at what Visa reported. Now, Visa's earnings were in line with expectations, and the revenue missed by about $20 million, but that's on an $8.9 billion revenue line, so about 0.2%. In my opinion, that's basically in line as well. And the market reaction at the time I'm recording this video was Visa being down about 3.5%. But let's take a deeper look at what they reported. Net revenues of $8.9 billion were up 10%. Non-GAAP net income was up 9%, and non-GAAP earnings per share up 12%. Now, in terms of their key business drivers, payments volume was up 7%, cross-border payments up 14%, and processed transactions up 10%. Plus, they executed share buybacks and dividends totaling a whopping $5.8 billion in the quarter. And if you look at previous Visa quarters, they actually look very similar to this one. Like, that amazing consistency is one of the things that I love about the stock. And if we compare how they did to their own guidance for the quarter, it looks like this. In terms of revenue, they expected high single digit on a nominal basis and low double digit on a constant dollar basis. And they were right at 10% on both, so they hit that. In terms of operating expense growth, they expected upper mid-single digit for GAAP, and they were at 4%. For non-GAAP, they expected low teens, and they were at 14%. So a little high on that non-GAAP, but generally in the ballpark of what they said. And then for earnings per share growth, they expected low 20s for GAAP and low double digit for non-GAAP, and they were at 20% and 12% respectively, basically hitting those marks as well. So again, I think Visa had a good quarter, and I think their management team continues to show that they have a really good handle on what we should expect as investors from a quarter-to-quarter basis. However, there were a couple things in this report that I thought were interesting for us to kind of take note of and monitor as we go forward. And that's namely revenue growth and expense growth. And here's why. While Visa's revenues have been pretty steady, we're starting to see slowing revenue growth, and you can see it just a bit in their key business drivers. If we look over the past 5 quarters, here's what we see. In terms of total revenue growth, it's been 10%, 10%, 9%, 11%, and 12%. And if we look at payments volume, we see that it was 7% in the most recent quarter, 8%, 8%, 9%, and 9%. And then lastly, if we looked at processed transactions, it was 10% in the current quarter, 11% last quarter, 9%, 10%, and 10%. Now, at first glance, these don't really seem so bad, especially processed transactions. But with payments volume, which is the total dollar amount processed, it's on a slight decline. And if you look at total revenue growth, it went from 12% to 10% from the same quarter last year. So technically decelerating revenue growth. And the question is that a real problem or just some normal fluctuation? I mean, we'll just have to see. But the other area I wanted to watch is operating expense growth. Because if you look at the non-GAAP number, they went up 14% year over year, which is mostly personnel, marketing, and G&A. And Visa talked about expenses going up a bit, and some of it being related to increased marketing spend for the Olympics, which is a huge event for them. And so look, overall, these are just things to watch. It's nothing to overreact to, but I think it's important that we try to catch these trends as they start to happen so that we're prepared and know what to look for as each earnings report comes out. And if we take a look at what they're forecasting for next quarter, it's revenue around the high single digits and low double digits again, expense growth in the single digits, which would actually be an improvement over the last couple quarters, and then lastly, earnings per share growth around the low double digits. So again, it's in the ballpark of what we expect from them each quarter. But overall, another solid quarter for Visa, and we'll just have to see where they are in a few months. Now, on to Google, and here's what I said I was looking for. Now, in terms of Alphabet or Google, I'm looking for continued rapid growth in their non-search business segments, as well as continued increase in their overall margins. So let's take a look at what Google reported. Overall revenue was up 15% year over year. Operating margin was up from 29% last year to 32% this year, and earnings per share up 31% from last year. And if we take a look at the breakdown from each business segment, search revenue up almost 14%, YouTube up 13%, Google Network was actually down 5%, but then Google Cloud was up almost 29% and continues to accelerate over the past 4 quarters. And then the other group is subscriptions, devices, and that type of thing, and it was up over 14% as well. So overall, based on what I was looking for from them, they really knocked it out of the park because they're getting good growth in just about all segments, and especially in places like YouTube and cloud. Improving margins 3% year over year is good as well, and it looks like all the rumblings about how they're going to lose market share in search isn't coming to fruition yet, and likely were well overstated. And I think part of what they actually put in their earnings release is exactly what investors want to hear from them, saying, as we invest to support our highest growth opportunities, we remain committed to creating investment capacity with our ongoing work to durably re-engineer our cost base. which to me is a very fancy way to say we're not going to go crazy on unnecessary spend. And speaking of spending, we talked about last week the possibility of Google buying cybersecurity company Wiz. And as it turns out, it seems that that deal has actually fallen apart with Wiz walking away from Google. And I'm just going to go out on a limb and say that the issues with CrowdStrike this week were probably part of the reasons why Wiz walked away from Google, because they're like, why should we settle for $23 billion when you have this company that was just around $100 billion a few weeks ago, having this major global issue that there's blood in the water as it relates to their reputation, to their clients, and Wiz probably sees it as an opportunity to maybe take some market share there and grow their business even higher than the $23 billion that Google was offering. And that's just my guess. I don't have any inside information. But still, in terms of Google's earnings, I couldn't be happier with where they're at, and they're really hitting the mark in terms of the things that I wanted to see. Okay, last but not least, let's talk about MSCI, and here's what I said I was looking for. Now, with MSCI, I want to see if their retention rates and operating margins have stabilized from the previous quarter, and that's specifically in their index and ESG business segments, since those were down pretty significantly last quarter. So let's take a look at what MSCI reported. Operating revenues were up 14%, organic revenue growth, which means outside of any acquisitions they made, was up 9.7%. Recurring subscription revenues were up 14.4%, asset-based fees up 18.2%, and their operating margin was 54%, with their adjusted margin over 60%. And the market seemed to like it, sending MSCI up around 8% on the day after reaching as high as 12% or so during trading. Now, at first glance, the operating margin is actually down from the year before, while the adjusted EBITDA margin is the same. But if we compare that to last quarter, their operating margin dipped down to 49.9%. So this at least seems to be a step in the right direction. But let's go ahead and take a look at their retention rates, because to me, this was the most concerning part of their earnings report last quarter. And that's because in the previous quarter, their retention rates went down a lot across the board. Overall retention was down to 92.8% from 95.2%. The index segment was down over 3%, and the ESG segment was down over 5%. So now if we take a look at this current quarter, we see that overall retention is down, but it's in the ballpark at 94.8% versus 95.5%. Index is back up at 95.2% versus 95.8%, and then ESG also rose quite a bit at 94.3% versus 96.9%. So overall, this is a nice bounce back in retention. Like maybe it's not quite where we want it to be in terms of retention growing or staying at the same level it was before, but it's definitely a step in the right direction from where they were a quarter ago. And MSCI's had other good news in this quarter, especially their partnership with Moody's. And if you read the headline, it says Moody's and MSCI announced a strategic partnership to enhance transparency and deliver data-driven risk solutions, which obviously tells you nothing about anything, and it's just not helpful at all. It's just a terrible headline. But if you drill down, it says that the partnership will basically be Moody's being able to use and leverage MSCI's industry-leading ESG data, and MSCI being able to get access to Moody's Orbis database, which holds information about 500 million entities, which will help MSCI extend its private company ESG coverage. And speaking of, MSCI saw a huge jump in revenue in their private asset segment, 72% higher than the previous year, because now it includes revenue from Burgiss, which is one of their recent acquisitions. So hopefully what we'll see from MSCI is continued revenue growth, continued retention improvement, and optimization in terms of cost for their recent acquisitions. But in general, I thought it was a pretty good quarter for MSCI, and at least for me, the things that I was concerned about look to be headed in the right direction again. And actually, when it comes down to it, I think all four of these companies in my portfolio had pretty good showings, even if the market reaction doesn't say that. And here's the thing, the market reaction after earnings doesn't always make sense, right? We see these articles and these analysts, and they try to explain why these things happen from a fundamental reason. And you have to remember that the market is driven in large part by a lot of algorithms and people that are trading on more short-term time frames. So in some cases, it's just traders trading, and there's nothing really fundamental to be taken from it. But for a long-term investor like me, the reason why I think companies in my portfolio will go up over time is because I think they will continue to grow earnings and cash flow at a higher rate than their peers and the broader market. So that's why I stick to evaluating their results based on that perspective and see if my story is still intact. If it is, I just wait and expect the market to catch up over time, and I don't worry about short-term price movements. If it's not, then I simply evaluate if I think they're going to turn it around or if there are better opportunities to put my money into. And then next quarter, I do it all again. But at least so far, with my companies that have actually reported, the stories seem to be intact. But I'll probably do some deeper dives into their 10Qs and all that when they're published, but on the surface, I think they're performing well. Now, if you want to see my original analysis of when I added Google and MSCI to my portfolio, you can do that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.